group, and we feel like it's an important role is because traditionally financial advisor is a bit of a dirty word, and everybody feels like if they go and see a financial advisor that they're going to be sold products and not necessarily of the property nature. So we call ourselves wealth advisors at My Financial Group, and we are probably a little bit different in that we try to fulfill a role here so that you've still got access to relevant information and enable you to plan your big picture without having to worry about the products or being sold products, and we can talk about property as well. So I think that's an important role that we play, and we work really closely with the advisors that Matt discussed earlier in terms of the sponsors for the group. So I'll just sort of go through, obviously, a disclaimer that this is general information. This evening I'm just going to have a bit of a talk to you about looking at saving for retirement and what that actually means. Having a look at, if you are buying a property, what are some of the considerations that you should be thinking about beforehand, not afterwards, including tax, and then looking at a few options. So I'm up for just 15 minutes and I'll try to cover as much as I can in that time. So saving for retirement. So as we all know, life is a little bit of a journey, and some of us, well, not me, but maybe a couple of people lucky enough to still be in this range down here where life's exciting and looks like it's, no, not you guys, I'm definitely not in there. Looks like it's full of adventure and we've got the world ahead of us. So that's a great phase to be in, and pretty carefree attitude at that point in life, which is nice. As we approach this section here, however, we start to realise that there's a few more serious things that we need to think about in life and start to prepare ourselves for this phase here in retirement. So as you can see, there are certain things in life that we need, and then there are choices that we make, things that we want to enjoy, not only when we're accumulating, but later in life, hopefully, as well, which is my goal too. So what we have is a very short period of time to accumulate enough to actually provide for that on an ongoing basis. So one of the really important things, obviously in this country in particular, is the role that taxation plays along the way. Okay, so when you guys are buying a property, anyone tell me why you buy properties, why you invest and develop? Make money? Yeah. So we're doing it to make money. So we don't want to then go and unnecessarily have to give money away if we haven't planned for that properly. So they say with property you make money when you buy it, and it's true with taxation implication as well that you do make money when you buy it. Okay, so you need to buy it in the correct structure, planning for what your intentions are with that property. Okay, so very important things to consider. And I guess in terms of when we reach this point here, can anyone tell me what a basic lifestyle requires you to have in Australia? So I'm talking not upmarket dinners at the surf club, maybe once a fortnight at the Ari or something like that. One basic car between two people, a small house, no pets. How much are you going to need for that sort of lifestyle in Australia? Anyone want to take a guess? 60,000? Yeah, well that's nearly uncomfortable, so you could upgrade to a Camry with 60. But yeah, so a basic lifestyle, survival, so this is just survival, paying your water, your rates, your electricity, we all know what that's looking like lately. 32 to 36,000 per annum will allow you to survive, okay? So we're definitely not ribeye and definitely keeping things simple. So comfortable, okay. Now comfortable, you might look at a domestic holiday each year, or even lash out to international every 2 years, all right. So this is what we're terming as comfortable, okay. 58 to 65,000 is what you're going to require. Quite comfortable, 80 to 100. And less than 2% of our population actually have that as a net income after age 60. So that shows us that it's important to plan for, because a lot of people don't do it. You know, and you hear a lot of this information. I mean, we're in a society and a world now where we've got access to so much information that really there's no reason that we can't be looking at these things and planning for it. And if you're receiving this income from investments that are all in your own name, then what's going to happen to that income? You're going to pay tax, right? So it's important to plan out where the income's going to come from later. If you're building up a property portfolio to provide you with passive income in retirement, how are you going to structure that? Are you going to structure it in a way that you might save $1 today but pay $2 back then when you need it the most? Or are we structuring it in a way where, you know, we're going to save tax later on, okay, and while we're working we pay a little bit more now? So these are the long-term things that you will need to consider, and that's the main difference between the accountant and an advisor. There's a lot of other differences too. When Paul's here I like to show the differences, but in terms of the accountant, they're looking at year by year. Okay, so next year you'll save $3,000 on your tax return. That's great. When you retire, you'll pay back 10. So we need to project it out, have a look at what you're looking to accumulate. Is it properties you're developing and turning over, in which case you'll have profit? Where should that be sitting? Where should that go? How are you going to save your wealth for retirement and maximise what your income is? So we don't have very long to do this, 20, 30 years. And super, super comfortable, that's where I'm going to be, 1% of the population. Okay, so I'm just going to run through a bit of a case study. I don't have time to go through, you know, lots and lots of things tonight, but we're going to have a look at a quick case study just so I can demonstrate the differences in a tangible sort of way. So this is Terry and Jill, 40 and 41 years old. They're going to retire in 20 years, earning 180 and 65,000. They want to buy a property that's 850 and has sort of average criteria. Okay, so yielding 4%, grow at 3, you know, a bit of depreciation and some expenses they're allowed for. All right, so after we make the purchase, that's our income, loan repayments, costs and depreciation, and after 10 years, you know, conservatively at 3% this is, so the figures that we're using are quite conservative, and 9 times out of 10 they may be greater than this, but just for an example, gross to 1.142. So they've got 3 options, and I'd like for 3 volunteers to come up. They need to be very good looking because my signs are very ad hoc and they're written in text to pen, so we've got to take the focus off that. And I do have 3 great prizes of Alexandra Headland Surf Club t-shirts. So I'll be silent until you join me. 3 people. Thank you. Very modest too. So we could stand in a row. Thank you. All right, so these are our 3 options. It's like musical signs. So we've got buy the property outside super in one person's name, which is here, okay? Buy the property in a trust and or joint names. We're using 2, which is this one over here. And buy the property in super, okay, which is that one over there. Now the considerations are, you know, as I said, if you go to an accountant, you're saying to them, I want to reduce my tax right now, I don't want to pay any tax, then they're probably going to look at this as an option for you. Okay, well, right now you'll save $3,000 and that's great, so let's just dive in and buy it. All right, buying it in a trust and or joint names, then there'd be certain reasons for that as well. You may want some flexibility. You might not want it in super because you might be retiring when you're 50, so you want access to it, you're going to develop it, all sorts of different reasons that you might utilise that instead. And then potentially buying it in superannuation, which could be in addition to your existing property portfolio. So as you can see with conservative figures, this just illustrates that at that point in time in 10 years, when we evaluate what tax we'll be paying if we sell that property, then that's the difference. So 84,000 down to 34, or best case 0. all the way through. So this is where you need to be considering the tax implications now, but also at the time of sale, because as you can see, it does make a very big difference. All right, so we need to project that out and make sure we're considering that so that we can go from being comfortable to the top 2%. So if you guys would like to, you can go out and swap them at the end. So you just go and see Nick. You have to swap it over, it's a bit big. All right, so the main points there is, you know, you can borrow in all those instances to different amounts, and, you know, the lending specialist can talk to you about that. But if you are looking at the different options of what you can utilise for retirement, then you obviously have your own individual, the trust, and or superannuation, in which you can borrow in all three. I don't have time tonight to go into, you know, the full detail of how to do that, but you do have the option of doing that in all three. Okay, so the opportunities, I guess, in superannuation specifically, is that you can make a greater investment with your superannuation if you have it, you know, inside super already, and or if it is selected as the ideal structure for you to utilise, you can also put money into it to utilise that as a structure to invest, and likewise with a trust as well. So you can move money between the three in order to make sure that you've projected and had a look at what is the best option for you. All right, this is a little bit of an example. So what I didn't factor into that example, okay, was tax that you pay on income. So the rent, so when it becomes positively geared, okay? So we've assumed that time that you're going to retain the debt the whole time. But in actual fact, who's going to go into retirement still owing $2 million on a $3 million investment portfolio? Not me. So if we're paying these things off and they're becoming positive, then what happens to the surplus income that we have along the way for 20 years? What happens to that? Yeah, it gets taxed, right? So if it's getting added on to your marginal tax rate, getting taxed at 49.5% versus getting taxed at 15 or getting taxed at less via trust distribution, these are the things that we also need to weigh up. When are we paying our debt off, and how much are we putting on our debt? When are we actually going to be in a position where we have some passive income that we can live off? These are the questions and what we need to be looking at in our projections, so we actually have a mud map that we can measure ourselves on. Or we all just walk around and, you know, a bit aimless, and then 5 years prior to retirement realise how much the age pension pays us, and we think, I need to make some money pretty quickly. So these are the things that we need to be considering. So this example is a $600,000 property over a 20-year period, and it takes into account the income as well. So just illustrating the point that there's the capital gains tax that we just had a quick look at with our volunteers up the front, but there's also the income tax side. Okay, so you need to be weighing up both. Okay, so if it is positively geared, obviously something like a super or a trust or joint names, or, you know, maximising where we can distribute the positive income is going to be beneficial because there'll be less tax. If it is negatively geared, then potentially that's where your accountant or your advisor may be leaning more towards owning it in your own name initially, and that's what you need to start weighing up. Okay, so there's a range of things to consider. I've pretty much got the countdown coming. So, you know, what we need to consider, I think primarily, we always start with our clients by establishing a budget. And that's not something where we tell you you're spending too much on cable, so you've got to downgrade your packages and this sort of thing. It's just to establish what are you earning, what are you spending, and how much surplus do you actually have. Once we know the surplus that you have, we can tell you where to put it. We can show you different scenarios and projections that says if you put that here, this will be your outcome. If you do this with it, that will be your outcome. So knowing your surplus and knowing what you actually spend is a really good first step to establishing any plan that you have, whether it's for developing properties, you know, buying first property, paying down debt, that is the basis. Okay, these things then, you know, come into it, looking at the returns, the interest rate, the time frame, and paying debt down, and then ultimately the taxation as well. Okay, so borrowing inside superannuation has some complexities with it. Okay, it is a strict environment, so you do have to abide by certain rules and regulations. And if you're interested in that, it's something you should talk through with your advisor. Okay, so obviously advice can help by addressing those considerations that I just mentioned. So looking at your budget, your surplus, what are the angles, where can it go, and what's going to give you the best result personally in the long run.